Very much, Camilla. So this is a joint talk between three of us, actually. So I'll start, then Janice, and then finally Derek, who was interning with us. So first of all, the roadmap for the presentation is that I will start by talking about the background to this problem using textual information for trading using AI. And then Janice will take over, and she will go into details of some work which we did, which shows statistical results on actually trading millions of news articles on around 1,000 stocks. And then finally Derek will come and present results of his internship, where he worked on improving analysis of the articles for which we used the commercial method in the preceding experiments, and I will finally conclude. So the high-level dream of trading textual data is to create an artificial super analyst which is able to interpret a broad range of different documents and then make predictions based on these interpretations on what will happen to stocks in the future. And we care about this because then we can use these predictions to trade these stocks for profit. And it's called analyst because that's what human analysts do today. So it would be doing this in a machine, and artificial because it's machine. And on a low resolution view, this sort of super analyst dream would have three parts. So the first part would be some model of the world which would give context which could then be used to interpret things that are happening, new events in the world. Then second part is something that is able to sift through large amounts of data. So there's like 100,000 articles on average on each day and 500 million tweets, and then detect novelties in these articles and tweets, and then finally in the correct context say how these novelties are going to impact the stocks. So let's zoom into these different parts of this and have a bit higher resolution view of what that could actually look like. So let's look at one example tweet here. So we have a product announcement of a product announcement by Elon Musk. So this is information which was not known beforehand, and if we look at the price, what the price does around that time, we can see that the price went up. So this can initiate some curiosity. Can we now use this insight to design a system that does this over a large number of tweets or articles? And the actual focus which we take is that of news. So that's these 100,000 articles a day. And here what I'm showing is a landscape of media. So this chart is a media bias chart which positions different news sources on two axes. So the horizontal axis is political bias, and the vertical axis is quality of information. And the quality of information, if we go from top to bottom, is sort of classified based on the type of info. So here we have original fact reporting with the say the journalist on the ground and actually looking at new events. Then here we have re-reporting of these events, analysis of these events in some contexts, and then we come down to persuasion, opinion, and misleading information. And if we look at three concrete examples, I put the arrows at Reuters and The Economist and Daily Mail. So if we had, for example, say the Cambridge Analytica scandal with Facebook, so the way this would be covered in these three different sources may be that Reuters just states the fact, Economist goes into the say sophisticated analysis of it in terms of politics and history and privacy laws and so on, and Daily Mail may say something irrelevant about the outfit of Mark Zuckerberg on the day. So essentially each of these have different difficulties associated with them if we want to interpret the news from these sources. The top ones, so the ones that just report facts, require knowing the correct context to interpret these facts. The middle ones, which do complex analysis like The Economist, require the ability to extract from the text the complex statements of the author. And finally, this third category requires recognizing bias or incorrectness of information. And what we do in our experiments is we actually only focus on what's in this green box, and we will come into the details of this in the next slide. So I said that the sources of news differ, but also events differ from each other. So I'd argue that some events are much easier to interpret than other events. And let's look at two concrete examples. So the first concrete example is earnings surprise. And just to reiterate, we're interested in events about companies. And companies fundamentally exist to create products, services, sell them, and then they make profits from these services. And the profits are reported at quarterly frequency, and they say how much money they made in the last quarter. So clearly earnings is some concept that is close to the value of the company. And also earnings is something that happens regularly. Lots of companies have released earnings before, so we can look on average as a percentage of how surprising were the earnings for this company compared to expectations of analysts, say. What's the next day return from the stock? And because this is easy, this is done a lot as well, and you can use this simple model to do it algorithmically. Now if we take another event, which is company factory fire, then that event is first of all much rarer and harder to interpret the actual impact on the company, because it depends on the levels of damage and what was in the warehouse and so on, and only a very competent and familiar with the subject matter analyst can do it. And then to assess the price impact of that factory fire rather than just business impact would then require understanding psychology of traders, and individual traders are not observable, so it's very tough. So we don't actually, we ignore these mostly for our experiments, and have relatively easy to interpret events, not just earnings but also products though, and so on. And just one thing to contrast here is that a lot of the work on say AI for analysis of text has been done typically on IMDb dataset, which is movie reviews, and there's also some product reviews and so on. And I just want to contrast that here the world that you model and then the prediction task are much better bounded and closely related to each other. So here the watcher of the movie would experience some sequence of emotions, and then at the end they would say did they like the movie or not like the movie, and then they would write here how did they like the movie, and they would put some review score. And the task here is simply to guess this from that, and it's much easier job. So that's it from me. Janice will now go into the details of the actual experiments. There you go.
So Meelis has discussed why we want to trade using news data. Now the question is, well, how do we do this in practice? And the starting point for this is that there are a number of quite mature commercial products available, and the one that we're using is from Ravenpack. So the data they provide us is they have articles from thousands of sources which they are processing, and they are detecting entities in those articles. Entities can be companies, people, products, places, countries, commodities, and they're looking at those articles and giving us sentiment scores. So this data set we're looking at as a history back to 2000, so they've also got quite a long history. To kind of give an overview of what this Ravenpack analyzer is doing, I just want to run through an example article, and this article is from November 2016, and it's reporting that the acquisition of Solar City by Tesla has just obtained shareholder approval. So the first thing that Ravenpack do when they receive an article is they look for entities in this. So we can see there's quite a lot of mentions of Tesla, Solar City, shareholders and analysts, and finally a couple of mentions of Goldman Sachs. And so they look at the distinct entities which they recognise, and they measure the relevance of those to the particular article. So Tesla and Solar City here have got the same relevance. This is a score out of 100 because they appear in the headline, and it is about them. They receive quite a high score, and in comparison, Goldman gets a score of 6 because they're much lower down in the article and they're just commenting on the event. So the next approach they take is to find events in this article, and what they do is they try to match the text to templates. These templates have been defined by their in-house team of financial analysts, and they're short snippets of text, so generally 3 to 7 words. And the first one they've matched is Solar City shareholders approve the acquisition. They assign these to a group. They give that particular event a relevance to the article itself, so this is 80 because it's in the second paragraph, and then they assign a sentiment to that event. So this event is purely been assigned to Solar City. It's the acquisition event, and sentiment is positive. The next one is that Solar City's stock price has risen 2.4%. It's got relevance of 50 because it's halfway down the article, and it's got a sentiment of 0.47. That's between 1 and -1, so this is positive. It's matched an event to Tesla, commenting on their revenues from the previous year. It's quite low relevance, and also 0 sentiment there. And an event which is the merger is assigned to both of them with a positive sentiment and something about earnings at the bottom. It's notable the things that it's missed, so it hasn't got anything with very high relevance in the headline, and it's missed quite a negative comment about the merger from Goldman Sachs. So just in summary, the approach that they're taking is they are detecting entities and their relevance, they're detecting these events, these short snippets of text, and then they're providing scores on the events and also a full article score. But we are concentrating on events. And so once we've got events, the events are given a location, which is its relevance to the article, and also a novelty score. So in news you see a lot of articles from being repeated over various sources. So we really want to just look at the very novel events. And this plot just shows of the events for our European universe. It's roughly 1,000 European stocks. These are the breakdown of the event categories that we saw for various years from 2000. And as Meelis was saying, we are concentrating on kind of easy to interpret events here. You can see there's earnings in red, there's dividends, analyst ratings. So these are all the easy to interpret event categories. And so what we hope is that the sentiment scores for highly relevant and novel events would be better predictors of returns. And so to try and see if this is in fact the case, we can run an event study. And so we're looking at events for 1,000 European stocks. We are filtering by these two categories. And because we're looking at daily returns, we're going to just build a daily signal because we could get many news events in a day. And what we're going to do is we are just going to categorise the events by the magnitude and the sign of the event sentiment, and we're just going to average over, say, very highly positive events or very highly negative events and see what we get. And so this is what we see. And what we can see here is we're kind of seeing the effect we want. We've got very high sentiment events seem to have positive next day returns, well, returns over the next 15 days. Highly negative sentiment stocks we see downward price moves. And so these are in the direction, and we see bigger moves for higher sentiment stocks. You can see day zero is the end of the day of the price move, so we can see that most of the move is actually happening on the day, so the reaction to these events is quite quick. And the other notable thing is we see quite a lot of move in the days leading up to the events, and we can see a number of reasons for this. I mean, you could just say maybe there's some information leakage to the market, but of these news sources that they are analysing, a number of them actually are quite lagged, so they're kind of analysing earnings data and publishing something 24 hours later. And actually a lot of news is just reporting that the price has moved, so then you would expect to see this. So moving on from this, actually what this doesn't show is actually, because the scale of this move is so large, there is still a slight drift after the event. So we next try and build a trading strategy from this. So we look at residual returns, which have the returns from all the signals stripped out. So we're really trying to isolate the effect of our news signal here. And we look to regress the next day returns against our event sentiment signal. And we do this using all stocks data for the last year, and we rerun our regression every month. And you can see here that beta is the constant proportionality, really shows how predictive this sentiment is of our next day returns. And these are the results for our beta, so our beta is positive, so it is predictive. Basis points here is 1/100%. As you can see that, post-financial crisis, our signal here is predictive of a 0.5% next day move in the returns. So this all looks good. We can next build a portfolio out of these stocks and say, using these coefficients from our regression, let's calculate the expected next day return. We can use those as our portfolio weights, and then if we invest in this portfolio, this is our return profile. So you can see that over our backtest period, we're roughly kind of doubling the amount invested. So just to show that there's a lot of value in this signal, but there's a couple of things to note. One is that this actually relationship does seem to be decaying a bit in recent years. And the thing I haven't shown is this is gross of costs, and as soon as you take costs into account with this signal, it's extremely high turnover. You get something that actually makes a loss. So we do need to do something better. A number of things we can do, but Derek is going to talk about his work in looking again at the analyzer.
Okay. So during my internship with Cantab, my general goal was to improve the performance of the sentiment analysis pipeline. And if you want better machine learning, you can either improve your algorithm's performance on your existing data, or you can get more data. And in either case, we needed an algorithm that can handle longer and more complex sentences from these news articles. So Janice kind of already covered how commercial analyzers take out extracts of events from news articles and perform sentiment analysis only on these extracts. So in this example, the commercial analyzer picks up Sainsbury's acquisition of Asda not to be completed. It only picks up the first clause of this headline, and it misses the sentiment correlated to this negating clause. And in complex examples like these, the negating clause cancels all positive sentiment from the previous clause. So this sentiment analyzer gives the wrong sentiment score to these types of headlines. And this isn't really an uncommon problem either. So for this particular commercial analyzer, we see that it often uses only a fraction of headlines to extract sentiment, and it might be missing out on a lot of important information that comes at the end of these headlines. And another downside to these commercial analyzers is they use bag-of-word embeddings. So bag of word embeddings take the words of the article and turn them into frequencies of the appearance for each word, and it completely ignores the structure of the language. So this has two downsides. The first is we can lose entity information. So in this sentence, we have Mrs. Clinton represented by the pronoun she in the next clause. And without the structure of this sentence, we don't know if she is referring to Mrs. Clinton or Mr. Obama. So we don't know to which company in the examples we're worried about the sentiment should be ascribed to. And even more fundamentally, without structure of language, it's harder to determine sentiment. So to fix this, we use a neural network. And I think by now we all have a general understanding of the basic structure of neural networks, so I'll skip this. And specifically, we use a recurrent neural net with long short-term memory cells. And a recurrent neural network is especially well suited for sentiment analysis because it includes this recurrent loop between hidden layers that allows better sequential prediction, and it allows the propagation of long-term structures within the sequences that we observe. So it can learn long-term structures in language. Okay, and we tested our model on two data sets, IMDb, just as a baseline, because movie reviews are easy for sentiment analyzers, and also Ravenpack's data set as well. Oh, and we compared our model to a logistic regression baseline. Okay, and just information about the data sets. The important things are that we had very large data sets with equal splits of positive and negative sentiments. And for our performance measures, we use precision recall curves and ROC curves. And the important thing is that more area under the curve is better. Okay, and with the IMDb dataset, we see our LSTM performs significantly better than just plain old logistic regression. And this suggests the intuitive fact that the structure of the language matters for sentiment prediction, and that the LSTM can actually learn long-term structures in these language examples. And also, we performed comparable to the state of the art. And then when we apply our model to the Ravenpack dataset, we see similar but not quite as drastic performance improvement. Okay, and in this example, we're showing how our LSTM reads sentences and determines sentiment compared to the logistic regression baseline. So we can see the LSTM is much more flexible, and it's much better at changing its sentiment score when it reaches a conjunctive or a negating clause. And you see with the LSTM, it decides on the sentiment early on, and as it sees more of the sentence, it can't really change its mind. So the LSTM is much better for a language modeler. Okay, and now Meelis will conclude.
Great, thank you.
Mm-hmm.
Okay, so we attempted to give an introduction to this big problem, and it's a really challenging problem, first of all. You know, we presented our work which focused on specific event types and types of articles. And you know, we demonstrated some promising results, and then Derek also showed some promising results using LSTM to model the language more precisely. You know, overall, this area, you know, the sort of the ratio of the known and the unknown area is you know, there's a lot of stuff still to work on and improve. So we have potential future intern projects to try to learn a bit more and do better than what we've managed so far. So one of these would be deep learning on longer documents. So as you saw in the IMDb case, the improvement by using LSTM was much better because the text was longer. In these small snippets from headlines, there's just not enough to actually start to benefit from these more complex approaches. And then there's the potential to start to do better at interpreting harder to interpret event categories like, products and services, for example, which gets further away from immediate price impact. So yeah, thank you very much, and we would welcome your questions.
Okay, so we do have time for 1 or 2 questions. Has any?
So have you thought about combining the text data with maybe stock data? Because it seemed like there was some correlation leading up to the event that you could see from the stock prices themselves.
So your question is using stock prices as well as the...
Yeah, because you did show some correlation there.
Yes, yeah. So we have looked at that, and the aim is to use this in combination with some maybe slower signals from the fundamental data and the price data to really get control of the turnover, which is kind of in its simple form that we've got here is what really kills it.
Okay, well, I guess it's thank Meelis, Janice, and Derek again.